How insurance companies invest your whole life premiums and why it matters. So when you think about life insurance, you probably think about protection, not growth. But what if I told you that the money that you put into a participating whole life insurance policy isn't just sitting there, it's being professionally managed, invested, and grown. It's safely, securely, and consistently. So in fact, many Canadian life insurance companies have been paying dividends to policyholders for over 150 years. Some longer than Canada has even existed. So today, we're diving into exactly where your premium dollars go, how do insurance companies invest them, and why this makes whole life insurance one of the most stable, long-term wealth-building tools available. Hi, my name is Laurent Munier, and I'm a partner and advisor here at Safe Pacific Financial. And if you're new to the channel, welcome. And if you've been with us before, welcome back. Thanks for joining. At Safe Pacific, we specialize in helping Canadian business owners, families, and retirees grow, protect, and transfer their wealth using advanced yet easy to understand financial strategies like participating whole life, infinite banking, and immediate financing arrangements. So if you want to work with us to help with your financial plan, you can visit our website, safepacific.com, and send us a message through there, and somebody will reply to you and we'll set up a meeting time. Alrighty. Let's jump in. How does buying participating whole life insurance actually grow your wealth in Canada? So when most Canadians think about life insurance, they think about it purely as protection or a necessary expense, another monthly bill, or something that you pay into just in case. But if I tell you that participating whole life insurance can be so much more than just protection, it's a powerful, stable, wealth-building tool that's smart business owners, professionals, and families across Canada are using to grow their assets tax efficiently, to access liquidity when needed, and to build multi-generational legacies. So here's how it works. When you buy a participating whole life insurance policy from one of Canada's major insurance companies like Canada Life, Manulife, Sun Life, Equitable Life, a portion of every premium you pay doesn't just cover insurance costs. Instead, it's deposited into a massive, professionally managed participating account, which is essentially a private investment fund that's managed on your behalf. So this participating account invests into a diversified, low volatility portfolio made up of high quality assets like government bonds, corporate bonds, real estate, infrastructure projects, and even private equity. So your money inside this fund grows steadily over time, and it's driven by a disciplined, long-term investment strategies that are designed to minimize risk and maximize stable returns. And the best part is, as a participating holder, as a policyholder, you get to participate in the success of that fund. So each year, based on the fund's performance, you're eligible to receive a tax-advantaged dividend, which could either do a bunch of things: increase your policy's cash value, it can purchase additional paid-up insurance, it can help pay for premiums, or it could even be taken as cash, and this all depends on your needs. Plus, all the growth inside your policy is tax-deferred, meaning that your cash value compounds faster than it would in a typical taxable investment account, like a non-registered brokerage account. So what does the participating account actually invest in? So when you invest into a participating whole life policy in Canada, you're not just buying insurance, you're indirectly tapping into a professionally managed multi-billion-dollar investment portfolio. And Canada's largest insurance companies, including Canada Life, Manulife, Sun Life, Equitable Life, they pool the premiums from participating policyholders into what's called a participating account. So this account is carefully and conservatively managed to ensure steady, long-term growth, low volatility, and the financial strength to pay out dividends year after year. So now here's a closer look at where your money's actually invested. Number one, it's in fixed income securities, which would be things like bonds or debt instruments. So participating accounts invest heavily in high quality government bonds and investment grade corporate bonds. So these are called fixed income assets, and they provide a stable and predictable return, and they help ensure that the insurance company can meet long-term obligations to policyholders. So think of this as the solid foundation of the portfolio, generating consistent cash flow with minimal risk. They also invest in carefully selected equities. So while equities or stocks are more volatile than bonds, they offer potential for higher long-term returns. So the participating accounts invest in blue chip, dividend-paying stocks, both in Canada and internationally, to add growth to the portfolio. So this stock exposure is usually very modest and managed very conservatively compared to a typical retail investment fund. They also invest in alternative investments, so real estate, infrastructure, private equity, and this is where participating accounts truly shine. So a significant portion of funds are usually allocated to alternative assets like commercial real estate. So this would be buying office towers or retail centers or industrial properties, multifamily residential buildings or rental apartments, infrastructure projects like utilities or transportation assets, and then private equity investments, so buying privately held companies. So for an example, Canada Life, one of the leading providers that we work with at Safe Pacific, manages $4.8 billion real estate portfolio spread across 81 high-quality properties across Canada. So these include iconic office buildings that you've probably seen, logistics hubs, and residential rental complexes. In fact, just as a side note, the grocery store that I shop at, the one that's closest to my house, is actually in a complex that's owned by the Canada Life Participating Fund. So, fun fact. When you stroll through downtown Vancouver or Toronto or Calgary and you see major office towers or retail spaces, you might be looking at a property that's backed by the participating whole life insurance premiums from thousands of Canadians. And so, why this diversified conservative strategy matters, right? The diversified nature of these participating accounts, so, blending the fixed income, the carefully managed equities, and the hard real estate assets, creates a stable and resilient portfolio that isn't overtly dependent on any one sector or asset class. So this diversification, it smooths the returns and it shields policyholders from extreme market volatility. It also enables insurers to pay consistent dividends to policyholders, even during challenging economic periods. And it ensures your cash value inside the policy grows reliably over the long term without the roller coaster ride that's often associated with the stock market investing. And then why do insurance companies invest so conservatively in Canada? Well, when you're buying a participating whole life insurance policy, you're counting on the insurance company to be there 5 years or 25 years or 50 years down the road. And they need to deliver the promised tax-free death benefit, and they need to be able to sustain that cash value growth for a really long time. So to make this guarantee a reality, the Canadian life insurance companies must invest conservatively and prudently, and they have to manage risk. So the insurance companies that I've talked about, like Canada Life, Manulife, Sun Life, Equitable Life, they operate under two massive non-negotiable priorities. So number one is the guaranteed death benefit payout. So no matter what happens in the economy, when a life insurance claim happens, whether that's tomorrow or 10 years from now or 50 years from now, the insurance company must pay out the agreed death benefit in full. There's no excuses allowed. There's no market condition clause. And that's why managing the participating accounts, they focus on stable, low-risk assets that can weather any economic storm. The second thing is that they have to maintain a strong financial reserve, and they have to meet strict regulatory capital requirements. So Canadian insurance companies are heavily regulated by government agency like OSFI, which is the Office of Superintendent of Financial Institutions. They must maintain a high capital adequacy ratio, which means that they have to have more assets than liabilities on their balance sheets. So this ensures that even during market downturns or unexpected claim surges, the insurance companies remain financially rock solid and can continue to fulfill promises to policyholders. So how do the Canadian life insurance companies achieve this stability? Well, to meet these long-term obligations, the insurance companies design their investment portfolios with three major objectives. So number one is they prioritize low volatility. So participating accounts heavily allocate to fixed income securities like the government bonds or blue chip corporate bonds because they provide steady, predictable returns without wild price swings. Unlike stock-heavy portfolios, these investments ensure that your cash value and your dividends remain stable even during market volatility. They also maintain high liquidity, so insurance companies must be able to access cash quickly to pay death claims, to pay dividends, and to loan out to policyholders as policy loans. So that's why they favor investments like bonds or real estate, because they get the rental income, or infrastructure projects that generate regular, reliable cash flow and are relatively easy to monetize if necessary. They also focus on long-term sustainable growth. So rather than chasing short-term stock market gains or high-risk ventures, Canadian life insurance companies invest for consistent, decades-long performance. Right? They seek investments that can compound steadily and minimize downside risk over multi-decade time horizons. And that's why they invest billions of dollars into assets like commercial real estate, right? So we talked about office towers, logistics hubs, apartment buildings, or infrastructure projects like utilities, transportation, a lot of renewable energy now. Actually, this is new. And also private fixed income assets like secured loans to large companies. These real world tangible investments provide inflation-resistant, stable cash flow, which is exactly what's needed to support both the guaranteed death benefits and the tax-advantaged cash value growth that make whole life insurance so powerful for Canadian families and business owners. How are dividends from participating whole life insurance calculated in Canada? Well, when you invest in a participating whole life insurance policy, one of the key benefits that you receive is the potential to earn dividends. But these dividends aren't like a random bonus. They're calculated each year based on the performance of the insurance company's underlying participating account. And there's several important factors that contribute to this. So here's what goes into determining how much dividend your policy could earn in a certain year. So number one is the investment performance of the participating account. So the largest driver of dividends is the investment returns that are generated by the participating account. And since these accounts are managed conservatively with a focus on fixed income, real estate, and private assets, they typically deliver stable, reliable returns over the long term. If the investment portfolio outperforms expectations, that extra profit is shared with the participating policyholders in the form of these tax-advantaged dividends that we've been talking about. Secondly, they have mortality experience, which is the claims and the payouts, the death benefit payouts. And this is another important factor, is this mortality experience, meaning how many death claims the company has to pay out compared to what they were expecting to pay out in that year. So if fewer policyholders pass away than in an anticipated year, the company has fewer claims to pay, which improves the overall financial health of the participating account. So those savings can be returned to policyholders through dividends. And this is actually something that no other type of investment has, right? Nobody else has this mortality expense. You can't get this in an ETF or a mutual fund or a GIC. Like nothing else has mortality credits. Only life insurance deals in this zone, I guess. The third thing that affects how much dividend you're going to get is the operational expense of managing the actual account. So insurance companies also factor in administrative and operational costs for managing the participating account. So if the expenses are kept lower than expected, so they have better cost management or they have better operational efficiencies, there's more money left over at the end of the day to allocate towards dividends. And what happens to the dividends? Well, when you receive a dividend from your Canadian whole life policy, you typically have several options. The first is to buy paid up additions, or POAs. So you use your dividend to purchase additional permanent insurance, which increases both the death benefit and the cash value. Another thing you could do is do reduced future payment. So you could apply your dividends to lower the out-of-pocket cost for future premiums. You could take the dividends in cash. So you could receive a check and you could receive the dividend payment directly. Although this is less common for long-term wealth building strategies, maybe we see these later when people are in a retirement age, right? They would just receive a check up for the dividend every year. That being said, those would become taxable. You could also leave the dividends on deposit. So some companies allow you to leave the dividends in an account to accumulate interest. Again, this is really specific and not a lot of people do this, but it is possible. At Safe Pacific, what we typically recommend is using the dividends to buy paid up additions, because this option grows your death benefit and this option also grows the cash values. And in the strategies that we use with our clients, a big part of that is having high early cash values that you can leverage against. And the best way to do that is to use paid up additions. So these participating accounts have a track record of stability that you can count on. When you're evaluating your financial products for your family or for your corporation, few can match the historical stability of Canadian participating whole life insurance dividends. For example, Canada Life has paid dividends consistently for over 175 years. So that's longer than Canada has even been a country. Manulife has been paying dividends to policyholders for over 130 years. So that includes world wars, depressions, recessions, market crashes. And this type of multi-generational consistency is extremely rare in the financial world. And it's one of the reasons that participating whole life insurance remains one of the most trusted foundations for tax-efficient wealth building, estate planning, and retirement strategies in Canada today. Now, let me leave you with some final thoughts. Participating whole life insurance is a financial engine. It's not just a financial safety net where when you can understand where the premium dollars are going and how they're invested, it's easy to see why participating whole life insurance is such a powerful tool, and it can help you to build stable, tax-advantaged wealth. It can create a guaranteed cash values and guaranteed death benefits. It can build stable, tax-advantaged wealth. It can create guaranteed liquidity through the cash values. It can help you to pass on a tax-free legacy to your family. And it helps you leverage different banking strategies like infinite banking or the immediate financing arrangement. So at Safe Pacific, we don't just sell insurance, we design full financial strategies using tools like whole life insurance to help you invest, grow, and eventually pass on your wealth. So if you want to work with us to set up your own participating whole life policy, and obviously this would be very customized to fit your goals and your situation, you can get at us through our website. It's safepacific.com. On there, there's plenty of buttons you can click that are going to send us a message. Those messages will come to me and the team. Somebody will reply to you within 24 hours to set up a meeting time where we can really get a better understanding of what you're trying to do. There's going to be a link to this below the video or on the video right now. We'd love the chance to talk to you and see if we can be a good fit to work together. Now, before you go, can I ask you a big favor? If you found this video helpful, please do the things that help the robots and the algorithms spread this message further. That means click the like button, leave a comment if you have a question, click the subscribe button. Life insurance generally doesn't go viral. It's hard to get these videos out to the many, many people that need to see it. Life insurance is traditionally not very exciting. Helping by pushing those buttons gets the algorithm to share this to more people that are like you. We're looking for Canadian business owners and Canadian families who want to take care of themselves and who want to grow their wealth over time. So again, safepacific.com is where you get at us. That's it for today's video. I'll see you next time.